welcome. You're watching Business Today Television. I'm Sakshi Batra and this is Modinomics 3.0 special edition of Market Today, presented to you by ICICI Direct, a show that will help you understand what is going to be taking place in the closing hour of the trade, the last hour before we see the budget day to light as well. And today we also will be joining by special guests, but before that, let's look at the markets right now. The Nifty is absolutely flat with a negative bias, 24,500 still there with us. It's the Nifty Bank that's still holding on to some green ticks right here. The India VIX is creating some volatility in the markets. You can see the current level of 15.2. That's a 3% uptick, although it's off the high point of the day. The broader markets are actually doing well. Both the mid caps and the small cap indices are up by about 1.5% each. We also have several other sectors that are participating into the markets today. So Nifty Pharma Index is something that you can see inching higher by almost 1.1%. It's the auto space that's driving in the top line, a 1% up move. You also see the metals, the PSU banks, the infra space abuzz with green and action positively. Consumer durables, financial services, private banks, those are the sectors that are still holding up. Let's look at the top stocks on the Nifty right now. Grasim is up by 2.5%. Ultratech Cement follows, so 2.5% up for that one. NTPC, HDFC Bank, M&M, these are the top movers as far as the Nifty is concerned. Within the F&O space, you also have some interesting names like Indian Hotels really driving up in trade today, 8.5% higher for this one. JK Cement is another one that's up by 5.8%. Hindustan Copper, PI Industries, Oberoi Realty are some of the other flavorful stocks that are actually abuzz with all the action right now. Good afternoon, Shell.
Good afternoon, ladies and gentlemen. We stand at the last 1 hour of trade ahead of the budget, and the markets for the moment are muted at best. We'll start with the usual profile of the Nifty. The index battling at 24,500 as far as the bulls and the bears are concerned, but down about 25 points as we speak. The IT index has slipped about 172 points lower. Strength coming in, Sakshi, on Nifty 500. The index itself outperforming the Nifty, up 0.3% at 22,936, and of course the Nifty Bank mildly in the green. But what's outperforming, ladies and gentlemen, are the PSU stocks. Let's look at the top performers ahead of the budget. No surprise here, fertilizer stocks, NFL, FACT, GSFC, GNFC, as also Rashtriya Chemicals and Fertilizers doing extremely well. Expectations that the government will come out with some kind of relief for the rural space, the farming sector which is in pain, is boiling this enthusiasm over. Defense is in fairly good shape. Remember, Moscow, Cochin Shipyard, BEL, BDL and BEML started in the red but are now moving up fairly sharply. An upper circuit on Cochin Shipyard, 5.5% gain on Moscow. Apart from that, PSU banks are abuzz. The mid-cap ones, PNB, Canara Bank, Union Bank of India showing decent gains, led by the big boy itself, State Bank of India. So that's the broader picture on how sectors and specific stocks are moving within the PSU basket and beyond. And Sakshi, we need to also keep in mind mid-cap cement. You mentioned Grasim, you mentioned Ultratech, because a lot of emphasis has to be given on infrastructure, the building of ports, roads, airports. 3 crore new houses have to be built over the next 5 years. That's what Mr. Narendra Modi said as his first official statement when he assumed charge on June 5th. So NBCC is in fine shape. HUDCO is doing pretty well. India Cements, Orient Cement, ACC, Ambuja, Grasim, Ultratech Cement. The list is long, but sectors such as cement and housing are doing pretty well, even though main indices, both the Nifty and the Bank Nifty, are muted. And why shouldn't they be, Sakshi? If you look at the Nifty over the last 7 weeks, a 2,000 point uptick from a low of 22,500 to 24,500. 7 weeks.
Absolutely. The rally has been stunning, and now everybody wants to know whether the budget will have in it to propel the markets even further from the current levels as well. So viewers, we will have a very special guest joining right in now. Our guest today is Mr. Pankaj Pandey, the research head of ICICI Direct, which is a trusted brand with which you can live the Ant life. That is, meet your aspirations with research-backed investments. Warm welcome to you, Pankaj, and thank you so much for taking the time out for this show. And of course, before we begin understanding from you the key stocks, sectors, themes that will be in focus, I want to take a broader understanding from you as far as the upcoming budget is concerned. And that is with regards to the economy. Will the budget 2024-2025 propel the economy on a sharp growth path right ahead?
So hi, good afternoon. Thanks for having me. I think when we sort of dissect the overall template of the government in the past few years, I think one thing is quite clear is that there are certain major focus areas. So for overall economy, I think the key focus area is to have lower inflation, higher growth. Inflation luckily has been good for us because globally we haven't seen crude doing much. Monsoon is expected to be good, so inflation is not a really big worry for us. I think 4.5% to 5% kind of a inflation is very much as an expectation and pretty normal also to have. Then I think last 3-4 years we are growing at 7% plus GDP kind of a growth rate, so that is there. And the last one is fiscal prudence. So I think overall, except for COVID period, fiscal prudence has been sort of maintained. And we would want to believe that this budget also is going to sort of be anchored around 2-3 parameters of these. While there is a concern that there could be some element of populism, because unlike in the previous past, we have seen this government being a coalition government, though the coalition is strong. But I think the only factor which needs to be watched out is the element of populism, which might be there in the budget. Otherwise, our sense is that this capex template, along with low inflation, high growth, and fiscal prudence, is going to be maintained. And which is why we believe that the current set of winners, sectors and stocks, that is unlikely to change much. Obviously, not. We don't expect everything to sort of perform in a single linear line. So I think, which is why you will have periods of correction. But I think the overall bias towards capex-oriented themes or core sectors, including some of the energy transition themes, is very much intact.
Okay. Hello, Mr. Pandey, and a very warm welcome to you on Business Today Television. Shail Bhatnagar this side. I just wanted to understand the medium-term outlook on some stocks that ICICI Securities might feel may outperform for long-term holders. Any names that you can think of with the budget in the background and of course the high capex that's expected by everybody?
So while there could be a long list, but I think I can highlight some of the names. So for example, one thing is clear that there is a decent amount of focus on renewable energy. The BJP Sankalp Patra talks about energy independence by 2047. And we all know that PSU banks have been sort of doing well, but there is a limitation in terms of PSU banks or any private sector banks in terms of having an exposure towards a certain sector, and which is why I feel that specialized NBFCs have a role to play. IREDA has been one stock which we have been quite bullish on. The results were already out. So, for example, while recent quarter 34% kind of a AUM growth is what we have seen. And we would want to believe that this is one company which can keep on delivering 30% AUM kind of a growth, because if you are going from, say, 172 gigawatt to 500 gigawatt, you are looking at a massive opportunity in the range of 20-25 lakh crores. Part of it is expected to be contributed by IREDA. Similarly, I think our belief is that the entire cement as a pack, be it large caps or mid caps, are attractively placed. Now, we understand that last quarter or this particular quarter is expected to be weakish because companies are not really driving growth through pricing, but more through volume growth. So which is why the big ones like, say, Ambuja Cement or ACC, or even tier 2 names like, say, for example, Sagar Cement or Birla Corporation, I think these are the stocks which are sort of looking attractive to us. Infra is another space which we believe can do well. So while L&T is obviously the preferred pick and kind of a portfolio stock for most of the capex themes, I think NCC is another stock which we have been liking for quite some time. I think if somebody can't really look at an exposure towards L&T, then NCC is one of the few companies to be looked at. And then we are also sort of looking at specialized road players, also the likes of KNR or even PNC Infra, because our sense is that while road infra has got its own share of attention, but I think expressways is something which probably might come up, and which is a high capex segment to be sort of looked at. So we are still sort of looking at almost a similar set of winners which have been there in the last 1 or 2 years.
Okay. Pankaj also wanted to understand about the key PSU sectors that have outperformed in the run-up to the budget, defence and railways. Will they continue to find flavour even after the budget? Or do you think, despite announcements of higher allocation, promising schemes coming in for these particular sectors, the best is already at the price?
So for defense, yes, I mean, you look at any defense PSU name, it's trading in excess of 45 times on a forward basis. So not much really juice is left with whatever numbers we are working up with. So any kind of a consolidation and price correction is a welcome correction we would expect. But yes, we would not expect them to sort of keep performing the way they have sort of done so. Similarly, for railway also, a similar move has sort of panned out. So I think while railway is also a very longish opportunity, but our sense is that given the already decent run-up what we have seen, probably some bit of a correction or consolidation is warranted, and that might provide a slightly better opportunity to sort of enter. But at the same time, when you look at some of the PSU banks, there has not been much of a price performance. They are in fact better placed compared to the private sector counterparts on CD ratio. They are well capitalized, and asset quality is really not a challenge for most of them. So we've been liking most of the names in PSUs. So be it State Bank of India or Bank of Baroda or something like Indian Bank.
Right. Pankaj, we'll also look at the broader theme. You've discussed what the budget is likely to do for PSUs, defence, housing. Within the infrastructure space, mostly we have all that we require in place, a fabulous road network. Airports seem to be done. Ports are getting expanded. So within the broader space of infrastructure, where do you see private capex coming up? In the sense that over the last 3.5 years, the government has done the heavy lifting. But what about corporate India? Where do you see fresh factories coming up? Which sector has more than 100% of capacity utilized and is now looking to expand brownfield or greenfield?
So I think when you sort of look at in terms of texture of capex, I think power is one sector which we feel that has a very long runway for growth, not only for this decade or even for a decade after. Largely because one, we are seeing multiple themes panning out. One, we are looking at energy transition from thermal to say renewable energy, which could be a combination of solar plus wind. Plus, there is a big hydrogen push what the government is looking at, and with power is very incremental or very pivotal in producing hydrogen, and which is where I think you see the maximum capex. So half of the capex is going towards the power sector, and we're liking most of the companies there. There's some companies, especially on the capital goods side, which are expensive, a bit difficult to justify, especially the MNCs. But when we sort of look at or when we speak to companies, our sense is that demand for some of the products like transformers, I think next 2-3 years, you really do not have capacities to sort of supply, and similarly for on the wind side. So I think you have pockets where the capacity is really in shortage, and which is why we feel that power as a theme is here to stay for a good period of time. And on top of it, what you're also looking to do is that there is energy transition happening in the auto side also. So power, I think, is one thing where we are liking the PSUs also and some of the private counterparts. But we really do not have a very big coverage across. So I think big ones, what we are liking is something like NTPC or in the, say for example, in the other domain, probably on the transmission and distribution side, some of the companies. But in general, power is one sector where we are seeing capex from both private players as well as PSUs.
Right. Pankaj, there is, a consensus across the board that much of the rally in the markets is in place, and except for large caps, most parts of the market appear overheated. You've mentioned some names in large caps such as NTPC that you prefer, but within this space, which is the lowest hanging fruit where you see continuous earnings growth and yet under appreciation by the market?
Very difficult question to sort of answer because I think when you look at India, I think we have got economic stability, we have got political stability, growth has been good. The only complaint with most of the people have with the Indian market is the valuations are rich. So be it large caps, mid caps, and small caps, you have pockets where the multiples are rich. And the richness in multiples is because of multiple reasons also. It's not that so one obviously is that the domestic liquidity is good. The other factor is that after a long period of time, there is a decent amount of comfort in terms of durability of growth rate, and which is why you are looking at companies beyond 2 years. Otherwise, typically when you sort of build models, you look at a visibility of 2 years, and basis that you attempt to sort of decipher a particular target price for a company. But now you are able to sort of, because there is a decent amount of comfort in terms of looking beyond 2 years also, which is why the multiples have gone up. Now, between large caps, mid caps, and small caps, I think again you have pockets where things are okay and things which are sort of rich. So, for example, within large caps, banks are relatively looking attractive. One, you could get a 14-15% kind of a growth rate. Asset quality is already pretty good. Valuations have not really been on a higher side. Similarly, in the mid cap and small cap, it's very stock specific. So, for example, to highlight, we have companies like, say, Philips Carbon Black, where we are comfortable with the kind of growth rate which company will deliver, and multiples are okay. So, I think within mid caps and small caps, it is a bit more challenging given the run up you have already seen. Mind you, for example, from June lows, we have seen nearly 23% kind of a rally in mid caps and 28% kind of a rally in small caps. It's a fairly large universe of 4,000 plus stocks. So that is where the challenge lies in terms of figuring out stocks where we have seen that kind of a run up, and also the story looks interesting. Similarly, if I have to highlight, CRAMS is one opportunity which is looking good to us. So Glenmark Life Sciences is also a company which is looking attractive to us. So you'll have to probably do a lot of figuring out in terms of which stocks will do well.
Okay. Pankaj, let's also look at some other sectors which are probably hopeful of some focus in the budget tomorrow. The tourism and the hospitality sector. A lot of interesting names buzzing today. Indian Hotels is up by 7.2%, and the entire space seems to be buzz with all the action. When we look at ITDC, several other stocks within the hotel space, Royal Orchid was moving in the morning. Tourism Finance Corporation is abuzz with about 3% higher moves coming in. Indian Hotels, we have the other stocks also. How are you looking at this entire tourism hospitality theme, and do you think investors can continue to benefit if they invest here?
So when you sort of look at the entire these set of companies which you spoke about, I think Indian Hotels is somewhere about 80,000 crore kind of a market cap. So probably the only company which is there in the mid cap domain. Most of them are sort of small caps. So if you have to play that hospitality theme, you'll have to largely look at these smaller cap themes. Now, the challenge when you sort of look at from these is one, that there has been a decent amount of price performance. but we are still liking this space largely because I think this is one of the few pockets which are going to benefit or which will keep benefiting from the trend of premiumization. So one is obviously the auto stocks. I mean, you look at standard features like alloy wheels or panoramic sunroof are becoming standard features. Similarly, one or twice holiday or two times holiday in a year is a bit sort of a becoming of a norm. And I think the kind of room rates, if you sort of look at, has seen quite a jump, and that is across segment. I mean, be it for lemon tree, be it for Indian hotels. And this is here to stay for some period of time. I think we are liking the entire set of themes where premiumization is at play, including this one. There could be some pockets of correction. And I think from the budget perspective, our sense would be that, see, the government is talking of making airports into regional transportation hubs. Plus, there is an expectation of being more focused on the tourism side. Any kind of a development there obviously will have a lot of these companies and sort of developing this sector, because this sector is quite important from an employment generation perspective, unlike a lot of other sectors where the mechanization does more of a job rather than human labor. So here, more human labor is required. So I would want to believe that this would be one of the focus areas of the government.
Right. What we'll do is just take a detour into the market, Sakshi. At the moment, there are about 1370 stocks in the green compared with 950 that are in the red. Major indices, the Sensex Nifty and the Bank Nifty are, just flat, doing nothing at all. The Nifty at 24,500 is down 30 points. Where is the action? The action is in mid-cap select. The index itself is up 2.5%, and you have a strong flow coming into mid-caps such as Indian hotels, which we've discussed. IDFC First Bank up 2.34% at 77.80. Lot of accumulation, ladies and gentlemen, is happening in Container Corporation. Remember, the government has put its divestment plans on the back foot as far as this railway giant is concerned. Persistent up 4%, 4,765. Lupin is 30 rupees higher at 1816, and you have a strong move coming into. Would you want me to mark MRF, Sakshi? 1,31,309. This is a common joke between us. Digit bhi fit nahi hote kabhi kabhi to. And of course, AU Bank 3.6% higher, 650, 650. So the action, whether we like it or not, ladies and gentlemen, is concentrated on mid caps. Pankaj just a moment ago mentioned the kind of overvaluations that you are seeing in this space, but the rally is unceasing. 2 or 3 days of dip, intraday dips, and those dips are purchased, and those same stocks move up higher and higher. Pankaj, again, consensus view that railway will do well. Over the last 3 years, we've seen capital allocation increase consistently. Any themes which you feel are yet to be fully explored within railway? What are your plus points there?
So one is, if you look at the sheer amount of capex which is going to happen in the railways is enormous. I think it's $750 odd billion kind of a capex is what is being talked of on a longer term. Because what you're trying to do is that you are going to move 28% of the freight share of the railways to 45%, and that will require a massive amount of capex. And then it's not only that we will have Mumbai Ahmedabad bullet train. I think what is being talked about is that possibly we might have these trains on other routes as well. Especially on the north side or in the south side. You will have a lot more opportunities which might come up. We are looking at some of the companies, not that we are we have a view on these companies, but so for example, we are positively inclined towards some of the companies like say Aircon, because besides L&T, this is one of the few companies which is eligible for participation in the high-speed train. So from that perspective, again, it's a very selective kind of opportunity we would sort of look at. And like I said, IRDA is again a sort of a very broad-based theme across all this. I mean, be it hydrogen, be it renewable energy, be it a lot of these themes which are going to come up. it's not that we are structurally negative. It is just that some of these themes have run up, so which is where we would expect them to sort of consolidate for a period of time, unless something surprises big time in the budget. Because see, railway and roads have been getting 50% of the overall capex allocation,
Yes.
and these allocations have gone up 5x in the last 4 5 years. So railway used to get an allocation of somewhere about 50,000 odd crores. Now that has moved beyond 2.5 lakh crores. And with the kind of capex what the government is talking, we would want to believe that that intensity is going to be maintained.
Pankaj also wanted to understand with respect to the entire consumption theme that everybody is focused on in the upcoming budget, rural focus, where do you think investors can keep their attention in? Should one really look at the irrigation related stocks? Should one look at staples or FMCG with that respect, or should one look at probably sugar related stocks where probably there could be announcements on ethanol blending? There is a hope that the PM Kisan scheme may get some extension and some hike right there. What is the best way to play the rural consumption theme?
So from a budget perspective, what looks believable is that this PM Kisan Yojana, where we are transferring about 6,000 odd rupees on an annual basis to about 11 crore farmers, that might get revised to somewhere about 7,500. Now, to sort of play something of this kind or other kind of a measure, I really do not subscribe to the fact that FMCGs or staples are one of the better bets. I think if I have to play that theme on the consumption side, I find the autos or two-wheelers as a sort of a better opportunity, because what we have seen in the last 3 4 years is that the average selling price even in two-wheelers has sort of gone up by 50 odd percent. So I think if somebody has more money, they would like to sort of upgrade themselves here. Similarly, I think consumer durable looks a lot more better across the value chain. So that is another. And I think one way to sort of play this also is the hospitals also, because hospital, while it is a sort of a forced consumption, but we believe that if things become better, I think rural area, we've seen a lot of segments or a lot of households sort of ignore health, and possibly better health access is going to be a lot more helpful, and that is where we would expect more of a secular growth to sort of pan out.
Right, Pankaj, thank you so much for your time, and we hope to interact with you a lot closely tomorrow, which is the D-Day as far as markets are concerned. Have a wonderful evening, and we look forward to you joining us tomorrow again.
Thank you so much.
Okay. With that, ladies and gentlemen, let's welcome Mr. Brijesh Singh. He's the Senior Technical Analyst at Stock Axis. The markets, as we had pointed out, are doing pretty much nothing as far as the main indices are concerned. The Nifty down 27 points, but 24,500 is with the bulls. The Nifty Bank at 52,245 is just 22 points in the deck. But what's happening fairly strongly, Sakshi mid cap Nifty 100 index is 1.2% higher. Yes. The small cap index is 0.83% higher, and in the green is the Nifty 500 index. Just the right time to get Brijesh ji's view in. Namaskar Brijesh ji, a very warm welcome. We have 25 minutes left to D-Day. What is looking good on the charts?
So good afternoon, Jalji. Overall, just for a Nifty and Bank Nifty point of view, I would be saying that still, they are just, consolidating, because tomorrow is a big event, the budget will be coming in. I feel like since October, November, there is an election also, looking at acting in the perspective of Maharashtra as well as Haryana, it feels like the budget would be, friendly towards the market. So Nifty, I don't feel it should break 24,100, immediately 24,400 is support for about 24,100, whereas on the higher side 24,850 and 24,650 are the resistance zone. Bank Nifty, if you consider, then 52,100 is a support immediately, and the turning point would be 51,500. That is another big support. If that thing breaks, then we can see Bank Nifty drifting down another 600 to 700 points. Otherwise, 51,500 and 52,000 should be kept as a support. Whereas on the higher side, it's been considered 52,400 is the first hurdle. If we overcome that, then 52,800 would be the another level to watch on the higher side. A few stocks which look good on the chart as well as on a buying perspective is considered, then I'll go with first call would be AU Bank. Now AU Bank is looking good on the chart at 654 around the stock has been quoting. So if someone wants to go long present rate or any dip towards 648, one can take a long position in it, with keeping a stop over 625 and play for the target of 685 with the holding time frame of 2 to 3 days. Another call would be a little bit on the buyers on the sell side. Jindal Steel, if we look out the counter on a hourly as well as 4 hourly chart, time frame or chart, is trading below the longer term moving average. Now it's quoting at 953, that is on the spot which I'm talking about, with increase in volume. So present rate or any rise towards the level of 960, also one can take a sell call in it, with keeping a stop around 970 and play for the target of 900 to 905. Holding time frame will be 2 to 3 trading session.
Okay, let's also welcome Amit Goel, co-founder and chief global strategist at Pace 360 is joining in for a discussion on what to expect ahead of the budget. Warm welcome to you, Mr. Goel, and thank you so much for taking the time out. I think everybody has this one question on their minds, and I'm sure many people must have asked you, what will happen to the stock markets after the budget? We've actually seen a one-way rally and some consolidation right ahead, with signs of cautiousness, nervousness, profit booking taking place now. So I think you can enlighten our viewers by what should be the strategy ahead of the budget and what will happen post the budget in the markets.
Thank you so much for having me on, Sakshi. So I guess we can only have conjectures at the moment, because we have very little clue as to what extent the budget will actually adhere to the expectations and to what extent it's going to be off the charts. But my sense is that while overall the markets remain extremely overvalued and overextended, and we've seen an amazing rally between 4th of June bottom till, let's say, the run up to the budget. It's only in the last 2 to 3 days that we've seen a minor correction. So I have a few points here. One, I think small cap and mid caps to me look uninvestable because of their high P ratios. So you are well aware that the P ratios there are north of 30. So they are in the vicinity of 34 to 35 on the trailing earnings. So I guess that space is still pretty uninvestable. But on the large cap side, there are some parts of the market where one could actually dip one's toes in the run up to the budget tomorrow 11 a.m. And my sense is that, for example, banking, if you look at it, it's not seemingly overpriced. If you look at some of the sub indices like PSE, PSU Bank, Pharma, they are probably still investable. So what one can do is that one can start buying a little between today and between the start of the budget session tomorrow. And let's say we can put in, if we have allocated about 100 rupees for, let's say for these few days, we can invest about 30 or 40 between now and then. And balance, we need to wait for the budget and see what goes, because there are quite a few expectations that are built into the budget going into this date. So I would say that the balance 60% one should invest in only one hears the budget proposals and one sees the market reaction. But on a long-term basis, this market is not a buy at all. It's only that there is a lot of money on the sideline. So by some estimates, 1.25 to 1.5 lakh crores is sitting with the mutual funds. And there are a lot of ultra HNIs and HNIs who are also sitting on the sidelines. So my sense is that if the budget is not so bad, there could be market could be off to the races immediately after the budget. So which is why pre-budget one could put in some money, balance, wait for the budget announcement. If the market starts running up too fast, then hold on, do not buy at all after the budget. But in case there is something in the budget which the markets look at unfavorably and there is a sharp fall, then one can probably continue to do one's buying between tomorrow and then maybe 1 or 2 days later as well.
Hello, Amit. Shall this side, of course, caution is the byword as far as fiduciary responsibility for PMS players such as you is concerned. And a fair point, small caps, mid caps look uninvestable. But what catches your eye within the pharma space? We've seen Lupin do dramatically well. Aurobindo, Glenmark, the mid cap space is again in the pharma sector doing amazingly well and on a ride of its own. What according to you is inexpensive relatively within the pharma space?
See, if you look at the overall pharma sector ETF, which which gets traded and which is a NSE ETF, I mean, which is an NSE sectoral index. So there the P ratio is in its 20s. It's in its mid 20s, and I would say that while even mid 20s is by no stretch a low P ratio, and it is one should not think that the pharma stocks are typically undervalued at the moment. But what we do recommend is that this is one part of the market where when the valuations in some of the other sectors are so high, if you look at FMCG, if you look at real estate, if you look at defense, manufacturing, construction, infrastructure, there the P ratios are so high that one has to look at some of the other sectors to invest without being forced to invest in a bubble-like market. And there are only few sectors which are left. So private banks is one. Then some of the PSU stocks, they are still quoting at P ratios of low double digits. Pharma sector is not too expensive. IT sector is not expensive, but we do not like IT for two reasons. One, there has been a sharp run-up in the last week to 10 days. And secondly, IT... we are not very optimistic about the growth rates on the IT sector for this year as well as for the next year. So we'll refrain from buying IT index. Now coming to what we would buy on is very specific stocks. And if there is an FDA action or if there is anything untoward or if there is a result announcement, quarterly result, which is below the market expectations. So my sense is that if you were to invest in that sectoral index through that ETF, that probably sounds like a better idea to me rather than picking up individual stocks without knowing what sort of risks they might sort of, they may sort of put on you when you buy individual stocks. So I would not recommend doing that. I would rather recommend buying the ETFs.
Okay, let's get in Brijesh into the conversation now. Brijesh ji, again, a lot of themes are showing some upticks again with the hopes of the upcoming budget. We have cement names, we have tourism, which we've discussed. We also have the defense names, something that has been one-way rallying. But again today, names like Cochin, GRSE, Mazagon, they're again rallying about 5% higher in trade. Railways, we did discuss how these spaces are also abuzz with action. Autos, auto ancillaries, these are the kind of themes that are working in. PLI is a big theme that everybody will be looking at for various sections of the manufacturing that could be underway. Your top sectoral benefits that one can look at from the upcoming budget and therefore the best picks from those sectors.
So actually, if we talk about, I'll play with the sector which look good to me is the chemical and the fertilizer, followed by some defense stock what we have discussed like Cochin or Mazda or even GRSC. So 2-3 stocks looks good. So I'll start with chemical and fertilizer stocks which looks good on the chart. So I'll give you 1 or 2 names. Like as a disclosure, we have recommended to our client at lower levels Sumitomo Chemical. Sumitomo Chemical looks good on the chart and 560 and odd it's been trading, and in today's session the stock had already made a new 52-week high with the volume breakout, and for a short term bet it's been considered. I'm looking for 550 to 5.
Which one did you say, Brijesh ji?
Sumitomo Chemical.
Fair
Okay.
point.
Go on.
Yeah, so that's look good on the chart as well. I was talking about it for a short term bet. It's been considered 550, 560 around. It looks to me with a stop loss of 500. Another chemical stock which looked good after making a high of 52-week high, that was fat 1187, and that made a base at around 980. So keeping that thing as a stop loss, present rate can be used to go long. Now it has been quoting at 1084, and one can play for the target of 1300 plus. Now, as I was been talking about some stocks which look good for the defense has been considered. So in that GRSC, Garden Rich Cigars looks good on the chart, after making a high of 2033. Now again it has made a base at around it's 50-day simple moving average, and it has bounced back from that level of 2350 or 80 around, and now it's been quoting at 2560. So present rate can be used to go long for the target back to the level of 2800 or 3000 odd level, with keeping a stop loss of 2300. Even Mazgaon Dock looks good at the present rate, 5300 even around is been trading. So present rate or dip below 5301 can take a long position with a stop loss of 5000, and then look back to the target of 6000 to 6200 with a time frame of 2 weeks to 3 weeks.
Brijeshi, I'm sure you heard into what Amit was saying in terms of overstretched numbers, and just 10 minutes ago we had Mr. Pankaj Pandey from ICICI Bank, ICICI Securities. He mentioned the extended valuations for all defense players, all of them moving above a PE of 50. Nevertheless, we'll take a Garden Reach from your side, simply because it's corrected from its most recent high, which was I think somewhere like 2700 or maybe 2900. Let's see what the budget brings into this. Cochin is circuit up, Sakshi, 5%, and would you believe it, it was somewhere like 2450 in the morning, and now it's at Cochin is trading at 2670. So day's low is 2460 and we are at 2670, circuit up. Paras Defense day's low is 1247, we are circuit up at 1379. Garden Reach, the low is 2380, we are at 2565, just about to hit circuit. All of these have now come down to 5% circuit limits, because 2020 1010 has been hit, and it's to curb these valuations and runaway rallies that we have these trigger mechanisms where successive circuits are slower, but absolutely no stopping cement. Shree Cement 2.4% higher. You have a fairly deep green tick across the board. We track what 33 cement companies for you, and 29 of them are in the green. Deccan Cement 3.5% higher. Mid caps are actually rising faster. Prism Johnson 2.7% higher, 160.4. Orient Cement 334, 335 now. I think this is a record high, 2.8% higher. Getting in, Amit, Mr. Goyal, cement also has been one of those relative underperformers in a broader market which surged rapidly. Do you like anything in cement, or is this something that you are avoiding on the PMS side?
Right. So, first of all, I would want to clarify, Shell, here that for us, investing right now is more like a tactical call than a strategic call, because strategically we would want to invest in the market when the P ratios and the valuations are a lot more comfortable than they are today. And my sense is that over the next 3 months, there is going to be at least one opportunity in the offing where the valuations would be somewhat reasonable and where one would be able to invest one's capital strategically. But till then, what we are doing is that we are doing a tactical allocation into equities, taking advantage of this little bit of pre-budget nervousness that is happening in the market. And we will invest the money, let's say, going up to right 11 a.m. tomorrow morning, and then we'll be watching the budget. And if there is a downward draft, or if there is a panic reaction on something that the finance minister says, then we would be out there in the market to buy. But at the same time, there is a lot of money waiting on the sidelines, which means that if the budget is not really, it's not really too disappointing. There is going to be a catch-up rally immediately after the budget, and Nifty could even cross 25,000 within the next few days. So, this is very clearly a tactical ploy and a tactical allocation and not a strategic allocation. Now, coming back to your question on cement, I think it does remain one of the more investable sectors because of the simple reason that the government is going to continue its focus on infrastructure and on low-cost housing. And all this rural and urban distress, you can say that if you continue to invest in low-cost housing and infrastructure, then you will, besides other measures, that does help to reduce the rural and urban distress and also helps us with the jobs. So my sense is that cement is something which is going to find budget rather favorable than unfavorable. So there is going to be a catch-up rally probably in the cement sector as well. And I do feel that it is one of the rather more investable sectors or sub-sectors because of the fact that the valuations are still not too rich. And plus, this being the middle of a monsoon season, you know that usually the sectoral sentiment is usually lowest around June and July, and then it picks up as we move towards the festive season and the post-monsoon season. So yes, I think a cement sectoral index can be a good idea as well.
Let me just ask you a counter-cyclical question, Amit. The budget is beyond our expectations. Nifty is 3% higher and moving further up. What happens to your strategy for a correction? See, everybody wants to buy the Nifty at 18,000. The only thing that's not agreeing in the room is Nifty.
Yeah. Absolutely. So I think that's a brilliant question, Shell. Thank you for asking me that. So basically, we are a multi-asset PMS. So we are, if we find that there are certain parts of the markets which are uninvestable, we would rather keep out of those sectors strategically, while we invest in some of the other sectors tactically, which is exactly what we are doing at the moment. In case there is a post-budget rally, the chances of which I would say are more than 60 to 70%, for the simple reason that there is a lot of money waiting on the sidelines. We would actually turn sellers as soon as we believe that this tactical rally has played out and now we should sell. Now, coming back to your question on the strategic allocation, we do not mind waiting for 1, 2, 3 months, or if necessary, even more to do our strategic allocation. Till then, we are happy to make our money in some of the other asset classes, which we have been doing. So we have been clocking a return of about 18 to 20% since inception. And there are times when we have not invested in equities for a long duration of 6 months to 10 months strategically. And still we've managed to make those kind of returns. So we are not asking the investors to take money out of equities and put that money into a fixed deposit or a savings account. That is an outright destruction of capital. What we are asking the investors to do is that they should also look for opportunities outside the equity asset class in case they find the equity asset class too overvalued and too rich in valuations, which is the situation right now. So right now, my focus is on two things. One, to make money on the other asset classes and then do these tactical ploys from time to time to juice up the returns from the equity market. But as far as the strategic asset allocation is concerned, we will wait for a deep correction, which in my opinion is not going to be less than 7 to 10%. And till that time, we will wait and we will continue to make our money either through the other asset classes or through our tactical ploys.
My final question to you, Amit, what is the percentage of equity assets in your overall portfolio mix?
Sure. So before we started this tactical allocation, which we actually started only from today because we saw this pre-budget nervousness and correction play out, we were sitting on an equity allocation which was more like 15%. And with this tactical allocation, we hope to go up to about 25 to 30%, let's say between today and tomorrow, or maybe a day after, in case there is a sell in the market post the budget. So that is going to be our peak equity allocation as of now. But yes, I definitely foresee 7 to 10% correction across all indices till the let's say till October. If that were to happen, then my tactical and strategic asset allocation put together will be more like 50% on equities. But till that time, we will do with tactical asset allocation, which does not go beyond 25 to 30%. And this tactical allocation, we will probably flip. We will probably book profits once we believe that this, let's say the post-budget rally, if it were to happen, has played its course. So we are going to book profits out of most of these holdings.
Okay. Amit, one last question on the show for you, and that is, any potential risks or uncertainties that you see in the markets post the budget?
Yes, so I think there are concerns about tinkering on the capital gains tax rate. My sense is that rather than tinkering too much with the rates, there is probably going to be a change in definition of long term, and there would be some attempt to not have too many different long term and capital gains tax structures for different listed asset classes. So there would be some attempt to consolidate, but in case there is something on that side which the market does not like, if the government were to increase the capital gains taxation on equities, or if they were to increase the STT to curb, let's say, excessive speculation and trading on the short-term trading on the equity market, on the F&O side, there is going to be a negative reaction. If there is, let's say, if there is no emphasis on PSU divestment, at least if the market if the government disappoints the market on their divestment targets, there could be some sell-off. So I think these 2-3 factors one need to watch out for, and there is a possibility that market does not like what the government says, and the market falls post budget. I would say the probability of that happening is somewhat less, because even if the budget is not great, even if it is just normal, the money on the sidelines will keep the market well bid. So my probability distribution is 60 to 70% chance that the market goes up, 30 to 40% chance that the market moves down. In case the market moves down, then one should continue to invest tactically for the next 2-3 sessions when the budget gets discounted. But yes, these are some of the risk factors. One should be cautious, and one should not invest too much of one's money before the budget, because you need to keep some dry powder for a post-budget correction. If that were to happen, even if the probability is probably less than 40% that there is going to be one.
Okay. Well, thank you so much, Amit, for being with us on this very special edition. We are just a minute away from the market close. So last word from you, Brijesh, top 2 stocks for tomorrow on the budget day.
So as I told, the chemical and fertilizer looks good. One can look out for Sumitomo Chemical and Chambal Fertilizer, and if defense has been considered, then play for HAL.
Okay.
With that, ladies and gentlemen, we'll draw this show to a close. It's been a fabulous rally over the last 7 weeks on the Nifty itself. An uptick of 2,000 points, will you believe it? In the last 7 weeks since 24th of May, we've rallied 2,000 points on the Nifty alone. And that speaks volumes about how the markets have built up their expectations of the budget, and it speaks volumes about liquidity that is there, both in terms of risk appetite as far as retail investors are concerned. Forget about ultra HNIs and forget about the money that is coming in from EPFO, from all sorts of channels into the market. Sakshi.
Absolutely. So there you have it. 15 point of a loss for the Nifty right ahead of the union budget. But at least we've held on to 24,515 is the final figure. The Nifty Bank, however, managed to shut shop about 1/10% higher at 52,328. Sectorally, it's definitely the autos, metals, pharma, infra that did well. Broader markets continued to do better than the benchmark indices. 1.3% higher for the mid-cap 100 index, a 1% uptick for the small-cap index today. What did not participate? IT, realty, FMCG, oil and gas tracked, while the other sectors managed to pull themselves up in the green. Let's look at the top 5 movers on the Nifty. Grasim, NTPC, Ultratech Cement, HDFC Bank, Power Grid and M&M. These were the top movers. On the downside, Wipro, Reliance Industries down 3.3%, Kotak Mahindra Bank, ITC, SBI Life, State Bank of India. These were the top drags as of now. But big performers on the F&O space, Indian Hotels, JK Cement, Hindustan Copper, PI Industries, Atul Limited. On the downside, Wipro declined by 9.2% in the F&O space. Reliance down by nearly 4%, Kotak Mahindra Bank about 3.3% lower, Birla Soft about 2.7% and ITC also dragged by about 1.8%. We'll wrap it up at that, viewers, but the action continues and now it paces forward to understanding the impact of the economic survey, the expectations from the union budget, all of it coming in on your screens very soon, right after the closing hours. But we will see you tomorrow as the live action takes place as far as the budget is concerned. Stay tuned with us on Business Today. Join us as we explain the impact of the first budget of Prime Minister Narendra Modi's third term.
Your investments, your future. Watch how the budget drives India's Atmanirbhar markets.
From taxes to healthcare, from Manrega to Ayushman Bharat, we bring you all the policy moves.
Get expert insights on how Nirmala Sitharaman's 7th budget affects your finances.
Decode the big numbers and the new policies shaping our nation's future. Tune in to Business Today for Modinomics.